What is up, guys? Your agent Tyler Wehrung here, and today we're going to talk a specific question around the HELOC. A question that I've been getting a lot lately is that I've just purchased a property. How long do I have to wait before I can go ahead and get a HELOC on that specific property? And today we're going to walk through 3 pieces of criteria that it'll come down to that'll really determine the answer to that question. The first piece of criteria is going to be something called seasoning. The second piece is going to come down to equity percentage. And the third piece is, have you liked this video yet? If you haven't, I'd be forever grateful if you do that. But with that, let's jump in. All right, guys, so if you're not familiar with the concept of seasoning or a seasoning period, banks call this a loan seasoning, the period in which after you purchase the property, you have to wait a certain time frame before they let you cash out refinance or refinance in general for a different value. Essentially, the bank wants to make sure you're not buying a property and then taking out a lot more debt than the property is worth too soon after you purchase it. So you can still go through some of those exercises, such as, refinance, HELOC, you can try to get those. However, the problem becomes the value they're going to use to determine that is going to be either the purchase price that you paid or the current appraised value. The key piece is whichever one of those is less. So typically that's going to be your purchase price, is where you're going to be limited on how much you can then go pull out of that property. So seasoning periods are typically between 6 months to 1 year with most big banks, big industry banks such as the Wells Fargo, the Bank of America, etc. So the key piece to avoid seasoning here with either a cash out refinance, HELOC, this is kind of a general concept, is go to local banks and credit unions or talk to other investors in your market to really understand what banks are allowing you to refinance or pull equity out of your home without that seasoning period. So that's step one. First, understand what your options are when it comes to seasoning and what local banks in your area are willing to offer you. The second piece really comes down to your equity percentage that you have in the home or the property. So if you'll recall, banks feel comfortable when there's a gap or they have that 20% equity between what you owe on the property versus what the property is currently worth. That's kind of their happy zone. So if you get into a property with 3.5% down, you're likely not going to be able to do a whole lot in terms of refinance or HELOCs until you build up that equity percent to get at least a 20%. That's kind of the line in the sand. And you really need to get beyond that before you start looking at a HELOC, because a HELOC is going to allow you to take anything above and beyond 20%. You're really going to have a tough time if you're wanting to tap into more than that 20% buffer range. However, when markets are hot, a couple years ago, I was able to get a 90% LTV HELOC on my primary residence. However, I can almost guarantee with the uncertainty in the market right now, you're going to have a tough time finding anything above an 80% loan to value HELOC. So you really need to understand what your equity position is. So this is a big factor with how you got into the deal and how good of a deal it was when you actually purchased it. In our business, we find deals that off market that are significantly less than market value. So we're typically able to tap into that equity right away because we also have a lender that doesn't require seasoning. But if you're buying a market value primary residence, you're likely going to have to sit on that for some time, pay down that principal, or wait for the appreciation to kick in to kind of build that equity position for you. So unfortunately, it's tough to give you a hard and fast rule when it comes to how quick can you refinance after you purchase a property. It is going to be property and situation specific. So for those reasons, you need to do 2 things. First, you need to figure out what your lending options are, what banks are doing in your area, and what options are available to you. Then you want to look at your property situation and say, how much equity do I have? What do I currently owe on this property, and what is it worth? And anything above and beyond that 20% is what you should think about in terms of opportunity that I have to tap into, and do I want to either pursue a refinance or a HELOC? As you guys know by now, I'm a big fan of the HELOC in any market, whether markets are up or down, interdependent of what interest rates are doing, because essentially when you open a HELOC, you're just giving yourself that opportunity. You're just opening a credit line, not for sure saying you're going to use it. You always have the chance to open it and leave it sit on the table, and typically you don't pay any fees associated for doing so. Versus if you jump into a home equity loan or a cash out refinance, you're going to be tied into that new interest rate and you're going to start paying interest on that whether you use it or not. So guys, while this isn't just a straightforward answer for everyone, I hope you at least know how to think about this and how to go about learning what information you need to come up with your own answer for your specific situation. And if you did get anything out of this, don't forget step 3 in the beginning. A like or subscribe would be greatly appreciated. And as always, a share with someone else who might get value out of this as well would be extremely appreciated, as all those things really just help the channel grow and tell YouTube there is some value in here in general. But with that, guys, we'll go ahead and wrap for today. I'm Tyler Wehrung, and we'll catch you next time.